Now, let's talk about one of my favorite strategies. It's an incredible strategy because it produces consistent income while lowering risk, and I think it's just a great addition to anyone's long-term investment portfolio. So let's jump into it. This is known as the option wheel strategy. And let me tell you, I thought I created this strategy. I started doing this strategy and I'm like, this makes so much sense. Why aren't more people doing it? So then I started Googling it and then I realized, holy crap, there's actually a place where people actually do this and it's termed the option wheel strategy. So it's like, you know that moment when you're like, I found something and this is incredible. And then you realize other people are doing it and you're able to get that confirmation bias that, oh my gosh, this works. So that's how I felt when I discovered that other option traders do this, and it just means that it works. So let's jump into it and talk about what it is. So this strategy, there are a few steps to it. It's not too complicated. You actually have all the building blocks we talked about earlier. It actually combines cash secured put plus the covered call. So this strategy begins with the cash secured put. So again, we're going to use hypothetical numbers and we're going to say right now a stock's trading at $100 because it's just a lot easier. So what we would do is we would sell a put option at $95. Now what happens when we sell this put option? We get to collect income, we make money. Now at expiration, or if you decide to close earlier, which is great, so we see is the stock trading below $95. If the answer is no, that means the put option expired worthless and we got to keep this money. So then we stay in this loop indefinitely. We go back, we sell another put option, and then we see is the stock trading below $95. If the answer is no, as in the put option expired worthless, we go back and we sell another put option and collect more income. So we stay here over and over again until eventually the stock does go below $95, assuming the market isn't trending, is just kind of flat, right? So eventually, let's say the stock does go below $95, at which case we become obligated to buy 100 shares at $95. Well, that's good, right? Because you wanted to own this stock anyways. So this actually, what just happened here? This whole process right here, this whole line is part of the cash secured put. We sell options, we collect income, and then we see is the stock above or below 95. And if it's below 95, now we own the stock. Great. Now that we own the stock, we can actually generate additional income from the other side through the covered call. What we do is we sell a call option at 105. Now, when we sell this call option, we get to collect an income. Similarly, we see is the stock trading above 105. If the answer is no, that means there's no option assignment. That means we can go and sell another call option and continue collecting income. And we stay in this loop indefinitely until eventually the stock actually goes above 105, at which point we become obligated to sell at 105. Now we have the cash available to go back and sell another put option at $95. We start with the cash secured put, then we end up with the covered call to exit the stock position, and then we go back to the cash secured put. Then after we get assigned, we go back to covered calls, and we just do this over and over again. Now imagine all this income that we're producing on both the calls and put sides. That's what makes this so beautiful, because you're collecting income. We're combining two of the best income producing strategies for option traders into one. But the major thing is you only want to do this with bullish securities only. As in, you only do this on stocks you want to own for the long run. So no meme stocks, even though their implied volatilities are super high and these option prices are very, very good. It sounds great, but you're going to get hurt if you do meme stocks. So no meme stocks. Don't do any speculation on bad companies. I'd say focus on S&P 500 or NASDAQ. Or if you want, you could do, the Russell 2000. So the tickers here are SPY, QQQ, or IWM. All right, now let's look at how you can actually execute this using a market example. Using these examples, let's say we sell put option at the 25 delta. We sell a put option at 255. We collect almost $6 in premium. And remember, we still have the buy to close at 50% order. If that doesn't execute, that means we're getting close to getting assigned. We accept the assignment, so now we own the stock at 255, but we have close to $6 in credit, so our cost basis is only about 249. Now we can sell call option above 249. So again, if the market's actually down here, we can sell a call option above 249 and we'll make money. Now, when we sell that call option, we can collect a decent amount of income. Let's say it's another $5 or so. And so just by selling this put option, actually, we're going to be outperforming someone who had just bought the stock outright. So that's already a great sign. Now, after that, you can decide to sell the call immediately or wait for the market to recover a little bit more to sell a call at a higher price. But again, during bear markets or during trending markets, it's very difficult to predict when the stock is actually going to recover. So I'd recommend creating a trading plan and then sticking with it and then following it as you should, regardless of what's happening. Of course, you can make tweaks to the plan, but once it's in your plan, stick with it because you made that decision rationally without letting any emotion get in the way. Now going back into this, you see how it creates a wheel? That's why it's called a wheel strategy. Awesome. Well, I'll see you guys in the next video.